Saurabh Mukherjea, good morning. Thank you for joining us. We've got your sense on the broader market and where the economy is headed. But I want to start with something which may be called a small space, but an outperforming space. That's the insurance sector. We may be staring at a slowdown in autos, consumer durables, consumer discretionary. But if the latest data from LIC2B is believed, the Indian insurance sector is still growing and growing. What is your take there? What is your sense here?
Well, look, there's no two ways about the fact that over the last 3 years, whether it's insurance, whether it's mutual fund flows, whether it's indeed PMS flows, if I take our own PMS at Marcellus, inflows have been very robust week after week, month after month. And it's this very little doubt that the country is going through a structural shift away from physical savings towards financial savings. Now, the Indian stock market doesn't have very many listed asset management companies. It does have, as you were mentioning, it does have several good insurers, and it's no surprise that as the insurance companies benefit from the financialization of the country, the stock market has fallen in love with them. And my reckoning is this love affair with the insurance will continue for a prolonged period of time as the financialization of the country continues. Just one area of concern though, I reckon we are set for a period of interest rates falling substantially. I would say 100 bips drop in interest rates, RBI interest rates over the next 12 months is not out of question. Insurance companies do earn a big part of their profits from financial income, from investment income. So a big drop in interest rates will hit the profitability of Indian insurers. But that's a ephemeral thing. That's a short-term thing. If you were to take a structural view, having at least one of these insurers in your portfolio would make sense. So I think in some of our portfolios we have ICICI Lombard. I don't personally have it, but in some of our clients' portfolios we have ICICI Lombard.
Okay, Saurabh, we were talking about this morning about valuations, about how it's only those handful of stocks that continue to see buying, and actually that remains your strategy, where you have also in the past as well said that you would stick to premium quality stocks in this market. When we're looking at that scenario, and given where valuations are currently, what really is the return potential then, for an average investor at a time like this, even if you're looking at, a year or more as your time frame?
So I think what's interesting, not just in these other sectors that we invest in, say paints and say FMCG, which we have discussed on your channel before, but even say if you take life insurance and general insurance, what's very clear both in life and in general insurance, what's very clear is you have no more than say 2 or 3 high quality life insurers, and I would say no more than 2 high quality general insurers, right? The numbers are as few as that. And obviously these are massive industries. They will grow enormously over the next 10-20 years. And hence, if you can lock into a high quality life insurer or a high quality general insurer, someone who's building dominant market share in this industry, someone who's got deep competitive advantages, either because of big data analytics or because of balance sheet strength, then you should be looking at 15-20% consistently compounded returns, even in spite of the current elevated levels of price to embedded value. So just like with HDFC Bank, where looking at the price to book value doesn't make you any wiser about whether you'll make money on HDFC Bank, I would say something similar holds on, say, insurers of the ilk of an ICICI Lombard or say an HDFC Life. These are high quality firms. They've proven over the last decade that they've built enormous competitive advantages, and over the next 10 years I think they will pull away from the rest of the herd even more than they currently are perceived to have pulled away.
Okay. What about pharma, Saurabh? Because I notice again that it's something that you're looking at, and interestingly, you've said focus on pharma companies with global businesses. Just talk to us about what you're seeing over there, given the current state, of some of these companies and the global environment as well.
I think that the short-term trigger that I had been looking for the last 8-9 months was the currency slide. I was a little surprised to see that the rupee strengthened as we went through the general election. Obviously, we saw the FII flows came in and the rupee strengthened in the run-up to the general election results. But post that, the rupee is sliding as I expected, and if you sort of buy my expectation that the rupee will end up somewhere in the mid-70s over a 12-month period, then there's a natural competitive trigger for our pharma companies. Now, what we have to be very careful here is this the FDA angle, and it's become a bit of a black box. It's very difficult to second guess who the FDA will go after. And in that context, I find Divi's Lab to be one of the better plays. It did have an FDA problem, but it got out of it very quickly. And because it doesn't manufacture end products which go head to head with Western Big Pharma, Divi's is a supplier to Western Big Pharma. It doesn't take on the Western Pharma companies head to head. It gives us a lot of confidence that the FDA problems will be muted in Divi's going forward. Secondly, it has a dominant global market position in painkillers. So around 80% of the world's naproxen comes from Divi's. Well-run company, deep competitive advantages, valuations are undemanding to my mind, and the short-term trigger over the next 12 months is potentially the rupee giving up, say, 6-7% of its value. We have Divi's in some of our clients' portfolios. I don't personally own the stock.
Right. Okay. You recently wrote, Saurabh, that must ask difficult questions to find companies that can fit into coffee can investment philosophy. Elaborate for the benefit of our viewers on the behavioral aspect.
Sure. So I think what all of us do is we obviously get very caught up on the numbers and what happened this quarter and what is the ROCE target. Beyond a point, those sorts of things actually tell you very little about a company. So what you're trying to understand is this a promoter who will play a long, patient game and build a franchise with deep competitive advantages? So if I were to meet the CEO of, say, one of the coffee can companies this quarter, the last thing I should be asking him is, how is current business? We all know it's a slowdown. So what you're trying to understand from a promoter is how will he allocate his free cash flow? He's generating surplus capital. How will he allocate his free cash flow? How does he choose his top people, the top 2 or 3 people who report into the promoter? How are they chosen? On what basis are they selected? What leading indicators that the promoter used to monitor his business? And what is his set of KPIs, his sort of dashboard of indicators that he uses to monitor his business? If you ask CEOs, promoters, those sorts of questions, you understand far more about their ability and willingness to play the long game and build a world-class franchise. If you ask them about what's going to happen in the next 2 or 3 quarters, that's a bit of a nonsense question. There's very little value to be gleaned from that. He will tell you what you want to hear, that yes, things will be difficult, but I will put up a brave show over the next 2 or 3 quarters. So we've tried to build an investment approach over reading 10-15 years of annual reports of a company before we go to see them, and then asking questions about how the promoter runs the business, how does he select his top people, how does he allocate capital, how does he build competitive advantages. We found that to be a more interesting way to identify high quality franchises.
Yes Bank 78, Vodafone Idea has reversed completely. Post the right issue, Saurabh, Vodafone has gone one way, Bharti has got one way. If the problems are here to stay for the telecom sector, then why markets are differentiating between both these telecom companies? I mean, frankly, there is very little to choose in between them in terms of a basic offering. Vodafone Idea has a poor network, and Airtel network is also not great. So as a consumer, if I switch or if I don't switch, I get the same experience. But the way markets are choosing between Vodafone Idea and Bharti, there seems to be a big difference.
Look, I'm not a telecom expert, but if I apply the framework that's worked for us in other sectors, what you typically are seeing in India in sector after sector, whether it's biscuits, whether it's paint, or indeed whether it's telecom, you're seeing 2 companies ending up accounting for 80-85% of the sector's profits. And I suppose implicitly what the markets are trying to figure out is, who are those 2? And my reckoning is at this juncture, it looks as if we're heading for a Jio-Bharti duopoly. And that's why I guess markets are a little concerned as to where does a Vodafone fit in a Jio-Bharti duopoly.
Monopoly either has got created or is about to get created, and markets are not factoring in. I mean, Asian Paints has 65-70% market share. Great news, but it's trading at a P multiple of 70. At some point in time, we had the same, monopoly which was there for LIC, but it was never listed. Where do you think this monopoly kind of structure is already there and markets are not recognizing it, or it's there for grabs, we must recognize it right now and invest in that company or that sector?
I guess, Nikunj, what happens is it's not that people don't realize Asian Paints' dominance. What people don't realize is what is the implication of that for the cash flows that Asian Paints will generate over the next 10 years. So when this company went public in 1982, I think, they went public in 1982, they already had 50-55% market share. And in spite of that, the stock is up 1700x in the 35 years since IPO, around 28% compounded. If you look at Asian Paints at any 10-year slice, take any 10-year slice of the firm since IPO, what you find is quite remarkable. Almost in any 10-year period, they'll give you volume growth of 11-12%, revenue growth of 14-15%, profit growth of 18-19-20%, and cash flow per share growth of 23-24-25%. Now, if you keep compounding an engine like that, and remember the market share gains haven't been massive really since IPO. They've gained market share, but the market share gains have been modest. In spite of that, they're compounding cash flow per share pretty consistently at 23, 24, 25%. If you keep doing that, then the current PE multiple, let's assume that the current PE multiple in Asian Paints halves, right? It's halves over the next 10 years. If the cash flow per share keeps bounding ahead by 23-25% and you add back the dividend, you'll still compound pretty comfortably at 20% on Asian Paints. And a similar dynamic, you asked about the life insurance companies, the general insurance companies. I reckon a similar dynamic could end up happening in dominant players in life and general insurance as well. The point I'm driving at is the human mind struggles to understand the impact of dominance over a 10-20 year period. And if you were to look at this on a global scale, companies such as Apple, such as Microsoft, such as Google are examples that if you can continue building dominance or reinforcing your dominance over 10-20 years, you make loads and loads of money, and both the sell-side analyst and I think the typical fund manager fails to comprehend the impact of that on your wealth.
Saurabh, great to have you on the show. Thanks as always for dropping by. That's the view coming in from Saurabh Mukherjea from Marcellus.